Good afternoon and welcome to LifeStages Facebook Live with our friends at AccuQuote. We're very excited that you have joined us to learn more about the importance of life insurance. At LifeStages, we provide resources and materials and access to experts to help you do that. And we're very happy to be here with our friends at AccuQuote today. And thank you to everyone who sent in questions ahead of time. We have a very rich list of questions, very thoughtful questions about life insurance, which we'll get to in a minute. But a few housekeeping items before we start. We will be taking questions live during the event. So if you have additional questions, you can either message them directly to LifeStages or you can enter them in our event page. Also, if you have any technical questions during the event, you can also send them through with the headline tech in your message. So with that, now I'd like to introduce today's guest. Byron Udell is the founder and chief executive officer of AccuQuote. Brian has more than 30 years of industry knowledge and is widely recognized as one of the nation's foremost life insurance and annuity industry experts. Byron's company, AccuQuote, is one of the nation's largest and most trusted life insurance brokerage firms that has helped millions of people find their best value for their life insurance needs. Most importantly, what you will find during this Q&A is Byron is extremely passionate about life insurance and helping people protect their family and their futures. So we're excited to have such an expert with us today. So welcome, Byron.
Thank you. It's good to be here.
So with that, let's get right into it because we have a lot of questions and we want to get to as many as we can. Those that send in questions, if we do not get to them in this 1 hour event, we will be posting the answers to those questions later. So we will get to everyone's question. So Byron, to start, we had quite a submission of life insurance questions, many ranging from the general, how do I go about it, what do I look for, to more specific. So let's start with some general questions. So we had a bunch of questions that just asked, how much life insurance do I need, and how do I go about finding out how much I need, and how can I figure that out? So can you answer, are there places that you can direct people or general rules of thumb before they enter into a conversation with a life insurance agent?
I'm glad that question came first because that is by far, head and shoulders, the most important question we're going to deal with today, the how much question. How much is the right amount? I often, when I'm training new agents, I often talk about this in the following context. I talk about if you were to say screw up your car insurance. Let's say you go out tomorrow morning and your car's not there and you parked it in your garage and you knew it was there. I think my car was stolen. And first call you're going to make is the police. I think my car was stolen. And the police say, yeah, we got 14 calls in your neighborhood for stolen cars and nothing we can do about it. The cars are on their way to Brazil. We'll never get them back. Call your car insurance guy. You call your car insurance guy and you say, hey, car insurance guy, I think my car was stolen. He's like, good, let me call you back in a minute. He calls you back and he says, Michelle, I got a little problem. That bill we sent you 6 weeks ago, you didn't pay it. And then we sent you a late notice 4 weeks ago, you didn't pay that. And then we sent you a lapse notice 2 weeks ago, you ignored that. I thought you left me and went to another car insurance company, but apparently you didn't. But we don't have your money, so your policy actually has lapsed. You have no coverage. What are you going to do? Well, you're going to probably get through it because you're here, you're working, you'll buy another car, you'll have 2 car payments for a while, you won't make that mistake again, but it's a mistake you can recover from. With life insurance, if you don't get the right amount, there really is no second bite at this apple. You've got to get it right the first time. So the importance of getting the right amount is truly, we treat that with the most focus of anything we do here, because if you get the wrong kind but you have the right amount, it's okay, because it's how much you get when you die. That's what the death benefit is all about. So again, let's talk about how we determine the amount. There's a number of ways to do it. There are an infinite number of needs calculators online, both on our website, on the Life Happens website. There are rules of thumb, which I've never been real fond of because rules of thumb are very relatively inflexible. They don't do a great job of really zoning in on the right number, the right amount. I do have a couple of gut check questions I like to ask clients when they're thinking about how much is the right amount. I ask them a question and say, I do tell them that before I ask them this question, I will say to them, it's very obvious that life insurance cannot replace a mother or a father or a husband or a wife. It's just not possible. Life insurance isn't that powerful. But what it can do, if you allow it to do, is to replace the economic value of a human life. So what was that life going to be worth to one's family? If one party's, nowadays there's often two breadwinners in a family, sometimes there's just one. Replacing what that person would have earned for the rest of their life is still going to be a loss, because you're going to lose the person isn't there anymore. They're not there to do their mother and father and husband and wife things. But we can replace that economic value. So how do we determine the economic value? One way, non-scientific way, I ask clients, if I were to write you a check right now for, if I were to write you a check for the amount of life insurance you're thinking about buying, let's say you make $80,000 or say you make $60,000, and I say to you, I will write you a check right now for the $500,000 worth of life insurance that you're asking me to acquire for you. I'll just write you a check for $500,000 tax-free dollars right now. If I did that, would you agree to work the rest of your life for no pay? And most people think about that not very long, and they say, heck no. That doesn't sound like a good deal, because I'm only 34 years old, and 34 years old, $500,000, one payment, I'm making $60,000 a year, I intend to get raises all the way through. It doesn't work. And so the rule of thumb of 10 times income or 8 times income or 12 times income, it really doesn't work very well. It doesn't adequately replace the economic value of a human life. The other question I sometimes ask is, if you went out jogging in the morning and you were waiting for the light to change, and the light changed and you're in the crosswalk and you start to cross and some truck makes a right turn and mows you down and kills you. Horrible to think about, I know. What would you think your family would sue the company of the truck driver? Would they sue them for $500,000 if you made $60,000? I mean, any good lawyer would come up with a case to say that your life was worth a whole lot more than that. Forget the pain and suffering, but it doesn't really matter how you die. Your family needs a certain amount of money. If you want to use rules of thumb, I would say people in their 20s or 30s, the carriers now are being much more liberal in what they're willing to allow in terms of face amounts and the amounts of coverage, somewhere between 20 and 30 times income. If you're in your 40s or 50s, it goes down a bit because you have less years of income to still replace using life insurance. But so overall, I would say when people call in, they generally in mind have a number that is lower than the true economic value of their life. So when we educate them and let them know that you probably need more life insurance than you thought you did, that's the bad news, I suppose. You're going to have to buy more of this stuff that you never wanted to buy to begin with, and I get that. But the good news is that it's often way less expensive than anyone could ever even fathom. I mean, today a 40-year-old male non-smoker can buy $500,000 of life insurance for about 65% less than they could 25 years ago. It used to be over $1,000 for that. Now it's $350. Women are even less than that. And so you can pretty much buy any amount that you want, and it's affordable, especially in a term insurance chassis. So, there's a lot to think about there. The good news is you can buy as much as you need and really have your family protected. And, every day when people die, most people are not expecting to die on the day they died. I wish I had a nickel every time someone said, I'm not planning on dying anytime soon, so I'm not in a hurry. Heck, we don't know that. If you knew you weren't going to die for another 3 or 4 years, then call me in 3 or 4 years. But you never really know that.
You brought up two things in your example there. One, I think, is a good, again, entree into our larger discussion where we had some general questions, and you used the analogy of car insurance, is why do I even need life insurance? And I think the subset of that question that we got was, with all the other insurance and financial pressures that I have to have car insurance, I have to have homeowners insurance. How do we elevate the necessity for life insurance? What would you give people as a headline of why it's so important?
It's only important if there are people in your life that rely on you financially that you care about. If you don't care about them, whether they rely on you or not, nothing I say is going to make any sense to you. Mm-hmm. There's no question about that. The other types of insurance that you mentioned, homeowners insurance or fire insurance, that's required. If you have a mortgage, your mortgagee is going to require that you prove that you continue to keep the coverage, because if the house burns down and you owe them $200,000 on the house, and it's not insured, they're never going to get paid back. So they require it. The law in pretty much all 50 states requires that you have some modicum of car insurance, some minimum amount of liability insurance. Life insurance is more about, first of all, there is a huge difference between those two types of insurance. The odds of your house burning down are roughly 1 in 1,200. We wouldn't think of not, even if you had your house paid off, you wouldn't think of not having it insured, even though the odds of it burning down are 1 in 1,200. The odds of dying, last I checked, are 1 out of 1. And so, since we are all going to die, we just don't know when. The question is, when we die, what legacy do we want to leave? If we die when we're young, that's the most tragic scenario. If we die, we live a long, healthy life, and we die at 85, like my dad just died a couple of months ago, he had a great life. He had a good run, and no regrets, no big deal. Obviously, I'm sad to lose him, but at the end of the day, if you die young, you've left. Not only have you left your family in a lurch, but the economic loss is just so incredibly huge. It's bigger than not insuring. And then we talked about losing a car, not having car insurance, big deal, whatever. You lost 20, 30 grand. To lose the rest of your life's income on behalf of your family is crazy. So that's why it's so important. It seems obvious to me. I've been doing this for 30 years, and we have roughly 200,000 clients, and we have death claims every single week, and I see what happens. And so far, we haven't had any surviving spouses or children or any beneficiaries of any kind come to me and say, demand to speak to the owner and say, what the heck did you sell my father or husband? This is crazy. It's $1 million. We're never going to be able to spend all this money. Can you please just give some of it back to maybe someone who needs it more than we do? That's never happened. I'm not expecting that to happen. So it's almost impossible, and I would say it's actually institutionally impossible to have too much life insurance. I know that sounds crazy coming from a guy who sells life insurance, and you can take it with an axe to grind if you understand I have an axe to grind, and you can take it with a grain of salt if you like. But the fact of the matter is the carriers will not sell you more than you need. They will not sell you more than they believe the economic value of your life is. So if you're buying it, it's not possible that it's too much. And the good news is it's so dirt cheap these days. I mean, for young people in their 30s, it's 50 cents to $1 a thousand if you're reasonably healthy. I mean, it's so cheap. It's almost incomprehensible. If I had sat down with the 10 top life insurance executives in 1994, and I had said to them that, we know how cheap term insurance has gotten now that it's 1994, and if I were to tell them that the price of term insurance for, say, a 20-year level term was going to be 2/3 lower. So what cost $1,000 today, which I thought was amazing, by the way, in 1994, when it dipped under $1,000, I actually bought $3 million of coverage, thinking, oh my God, I better grab it now before the price goes back up. This is crazy cheap. Now, what was $1,000 is now $350 or less if you're female, and so I am completely amazed. And yet, if I had sat down with those executives and said the price is going to be that cheap, they would have told me I'm crazy. They would say it's more likely that we'll all be living on the moon than life insurance will ever be that cheap, unless we find a cure for death. In other words, we find a way for people not to die, which hasn't happened. And we haven't had any medical breakthroughs since 1994. I mean, we've had medical breakthroughs. We haven't had any mammoth medical breakthroughs that are prolonging life and changing the mortality table that much.
Yeah, and I think it's a common misconception, and why people are hesitant, don't know what to ask, how to look, is that they think it is such an expense that they can't afford.
Interestingly, there's been some studies done on that, and the people tend to overestimate the cost of life insurance by a factor of 3 to 7, depending on their age. So people think it costs 3 times as much as it really does, or up to 7 times as much as it really does. And that's really tragic, because if they knew what it really cost, I think they'd be lined up from here to Alaska 5 wide to buy the stuff.
Plus the number of products that are available in every shape, size, amount. There's something for everyone.
There certainly are, and it's hard to fathom someone who legitimately needs life insurance, which is someone who has people depending on them and they have an income that's worth replacing. If they have both of those two things, then and they're reasonably healthy, life insurance is affordable. I mean, there are people that are truly uninsurable. I mean, they're so messed up. either from a health standpoint or a medical standpoint, that life insurance is complicated and expensive, but that's not usually the case, especially for young people.
And you mentioned in your intro also about dual income families. We received a couple of questions about for stay-at-home parents. So one was, my spouse stays at home with my kids and doesn't earn an income. Do I need to buy life insurance? So can you talk about the scenario? It was something that I think is not as well known, of insuring the unemployed spouse. So can you talk a little bit about that and the importance of that? What would you recommend to clients? The second part of that question we also had was, should you get one policy or two, or joint policies to cover both spouses?
Okay, let's answer the first part first, and if I forget the second part, you'll remind me, right? Okay. I think it's fairly common in life insurance training rooms to talk about covering a non-working spouse. And generally the discussion goes something like this. Well, what would happen, do you know what she does or he does, and what is all that worth, and what would it cost to hire someone to do those things if that person were to step out of the picture? You're busy at work. Many of us, well, a lot of the young people haven't seen the movie Kramer versus Kramer, but those of us that are my age and older have seen it. That was just a movie about divorce, about how a wife basically mother left the picture, and the father was doing well in his career, and all of a sudden the wife is gone, and the mother's gone, and he had to deal with his kid and his career, and all of a sudden his career started floundering, and he lost his job, and it was kind of a tragic movie to see it. But imagine losing a spouse 100%, not just a divorce, but a death. What would it cost to replace those things? So people think, well, how much life insurance do I need to be able to afford a nanny? And then I had a client call me, and that's all I learned when I was trained at the beginning 30 years ago. The nanny factor. How much do you need? Maybe $250, $300. That'll pay the price of a nanny. In those days, you could make 8 to 10% interest on a CD. So you thought, well, if I had $300,000 in the bank, I'm getting 10%. That's $30,000. That's what a nanny costs. Well, 10% in the bank. The word interest might be actually removed from the dictionary, because I'm not sure that anybody's getting it anymore. My kids don't even know what it is. And then nannies are not $30,000 anymore. So they're more expensive than that. But beyond that, I had a guy call me up for a quote. He was in his car, and he was a commodity trader making a lot of money, 7-figure guy. So this is a great call. I loved getting it. And he says, I need $8 million on myself, and I want $2 million on my wife. And I'm saying, okay, fine, I'll take that order all day long. I love that. And when I submitted it to the carrier pushed back a little bit. Not on him, because they recognized the $8 million made sense. But on the spouse, they're like, we don't understand why he needs $2 million on his wife. She doesn't work. She has no assets of her own. Tell me what he's thinking, or we can't issue this. And so I went back to him, because I wasn't really ready for that question from the carrier, and I said, Lance, what's your rationale for having $2 million in your spouse? He goes, I don't know. He said, Byron, it seems obvious to me. I have 3 kids. They're all under 5. My wife stays home with the kids. We also have a nanny to help her stay home with. She's there 24/7. She lives with us. If something happened to my wife, though, I can tell you right now, I'm not going back to work Monday morning. I may not go back to work for 6 months, a year, maybe 2 years. My kids are not going to understand. They're going to be saying, where's mommy? And I want to be there. And I'm certainly not going to just let some nanny raise my kids. I'm out the door at 6 a.m. I don't get home till after they get home from school. I'd have to be there to make sure they get off to school. I'd want to be there when they get home from school. I'd have to do a lot of the things that my wife does, because I'm not letting a nanny do that. And so I want the flexibility to be able to take some time off, and then I am going to have a loss of income as a result of my wife's death. Mm-hmm. And I'm thinking, oh my God, he's right. I mean, he really got it. And the next day I called the carrier, I explained it. They issued the $2 million on his wife, and the very next day I applied for $2 million on my wife, because I was working from 5 a.m. to 12 midnight when I was building this business. I was thinking there's no way I'd be able to do this if my wife wasn't around. My whole career would take a different trajectory. So there is an economic loss, even though there is no income directly to replace with the loss of a non-working spouse.
No, it's a good
and
point.
Then there's the nanny factor. So people need a whole lot more. And again, it's still not going to be all just fine when a non-working spouse passes away. It's still going to be difficult, even if you have all the money you need. But man, to add the money problems when you can buy, $500,000 or $1 million on a 35-year-old woman, let's say, for, a couple $100 a year. I mean, that's what we spend to go out to dinner sometimes.
Mm-hmm.
So
no,
it
it's
just
a good
seems silly
point,
not
because
to
it's
have
not
it.
just the nanny. Like the
That's
aha
right.
there is that the other spouse's career is probably going to be impacted, or they're going to pick up some.
There is definitely a loss of income almost every time, based upon the death of a non-working spouse. For the surviving spouse their career is different. They cannot spend as much time focused on it because they got to focus on things at home, assuming they care about their kids, which most people do.
Right. Okay, so another question we had was the life insurance application process. What should people expect? What's involved? And then a subset of that we got quite a few questions about was the necessity for a medical exam. You have a lot of people that are afraid of needles and doctors and want to know how to get around that. And I think maybe if you could speak to that, because even myself, I mean, I'm not a fan of the doctor, but it's not that invasive. It's blood and it's other samples.
Blood?
But it's not, I mean, it's not like you're getting a full, you're not going through a CAT scan, you're not doing all kinds of stress tests or anything like that. So if you could dispel that, because we got quite a few around that.
Well, going back, when I first got in the business, even up to $1 million, we were able to issue without a medical exam. I wrote $1 million on my wife back in 1986 with no medical exam, just to answer a bunch of questions. If you say you're healthy, we'll believe you, and we'll issue $1 million policy.
Can I just ask you on the no
Sure.
medical, though, in terms of age ranges, are there certain age ranges that only would apply to?
Generally, no medical insurance is available typically up to about age 60, and no medical insurance today is different than it was when I issued it on my spouse back in 1986. So I hope I don't lose track of all the questions, as this is a multi-part question. But the process generally goes as follows. People call in, we would, or if you met with an agent face-to-face, however you do it, you decide on what product you want, how much you want, what kind, and then we take an application. The application is basically legally an invitation to the carrier to make an offer of insurance. And so you're asked and you must answer honestly all of the questions on the application. They're going to ask you background questions. Are you the kind of person that do you regularly dive out of planes and skydive? Are you into scuba diving down to 300 feet? Are you doing anything hazardous? What's your medical history? What medications are you on? How much do you weigh? And then starting in the late 80s, because of the prevalence of AIDS at that time, the carriers wanted to screen out people that had HIV positive or that were HIV positive. And so they started examining everybody by doing blood tests. And once they got those blood tests, they became addicted to all of the other information they could find out about you by looking at your blood. And so they would be looking for cholesterol, triglycerides. There's 30 or 40 things they're checking for, including cocaine and nicotine, because if people lie, smoking is a huge, huge factor in terms of pricing. Smokers in their 30s would pay about 4 times as much for a 20-year term as a non-smoker that's healthy. It's a big difference. So people would lie about that. Now, once they have their blood, it's harder to lie about that. So for the last 20 or 30 years, the blood test and the urine specimen has been part of the underwriting process. So you answer the questions on the application, an exam is scheduled, the examiner comes to your house. Is it a hassle? I don't know. I mean, it's 30 to 40 minutes. You answer some questions. You get the copy of the blood results, so it's actually sort of a free exam. The insurance company's paying for it. But like you said, not everybody wants a stranger coming into their home to stick them with a needle. So what's happened lately as a result of the prevalence and development of big data, there's a lot of information that's out there that wasn't out there 30 years ago. Are you taking prescription drugs? If you ask that question to a client nowadays and they say they're not, there's a prescription database that can be checked. And if they're taking drugs for high blood pressure and they say they're not, it's going to show up anyway. And that could be a problem for the application process, because if you're not honest, they could decline you for just lack of candor. But the bottom line is that there are carriers out there that right now up to $500,000, we can get that up to age 60 with no exam whatsoever at fully underwritten pricing. In the past, if you asked me 5 years ago, I could have said, yeah, you could get $500,000 with no exam, but it used to cost 2 to 3 times as much as the kind where they had the opportunity to examine your blood and make sure you were one of the good risks. Now they're willing to take a shot based upon the data that's out there that you are one of the good risks and get you very, very close. In some cases, it actually is sometimes the lowest price, even without the exam, which is really, really cool. There is a limit, though. You can't get $3 million without an exam. Unless you started stacking some of these together. And I think ultimately, for the larger face amounts, they're still more comfortable with an exam because the carrier is taking a huge risk. They're taking literally, I mean, you're talking for $1 million policy, let's say, I don't know, $50 a month. I mean, $50 a month and they're willing to pay you $1 million if you die, they kind of need to know what they're getting involved in. And so they like the exam, they're more comfortable with the exam, but they recognize that the market pressures with some carriers doing these without exams is causing other carriers to sort of follow suit. And competition, which is obviously good, I mean, capitalism actually does work pretty well in the life insurance industry. That's the answer to the question that many of you may be thinking, why have rates come down by 60% over the past 20 years? It's basically capitalism working really, really well. The information flow today is so incredible that if a carrier is not competitive, everybody knows it, and they can't sell anything. And so they're forced to be competitive. And so that's why the rates continued. It was basically a price war for the last 20 years, is why rates have inched their way down.
Right, so the highlight there is if people are very opposed to doctors' medical exam, there's lots of options.
Assuming the face amount they want is say up to $500,000, there's some carriers that are now going to $1 million.
And something they should look into if they hadn't heard about before, and it sounds
Absolutely.
like there's many carriers doing it.
Absolutely, and good carriers. I mean, we're not talking about Fred's Life of Tuscaloosa. We're talking about major carriers that you've heard of that are A+ rated, that are now issuing contracts, life insurance contracts, without a medical exam.
Okay, great. We got a couple of questions around the need for life insurance to supplement what they get with their company policy. So we got a general question, then we got another one that was age specific of someone asking that their son had just gotten his first job. He was 21 and wanted to know if it was necessary to think about supplemental life insurance for him also outside of what he's receiving through his company.
Okay, let's again, this is a two-part question, and I've been very bad about remembering the second part of the question because
You're doing
I
great.
get wrapped up in the first part of the
So
question.
one was general, but one
The
was
first
then
part of the question is
specific
actually
for young.
more people are going to be wondering about the first one. There aren't too many 21-year-olds really thinking too much about life insurance, but I'll get to that in a moment. At work, typically people with their health insurance, if they have health insurance at work, it is made available for free usually at most employers for a token amount of life insurance, somewhere between 10 to 25,000. Sometimes it's one-time salary, but 10 to 25,000 is probably the most common thing that's included in your group health insurance plan. It's a little bit of life insurance just to basically cover burial expenses. Oftentimes people are allowed in an enrollment period each year to buy up or buy additional coverage without a medical exam at work. And you might say, well, is that a good deal? Should I think about that? And I would say, I have never seen one that's a good deal. It's usually a bad deal. And the reason it's a bad deal is because there is no medical involved. The people that are the sickest tend to be the ones that grab the most of it. And the carrier sort of knows this, which is called anti-selection, which means they kind of know the bad risks are the ones that are going to pile on, and they price it that way. And so if you're healthy, you're better off going out into the private marketplace and proving that you're in good health. The other thing is those group plans tend to have rates that are basically in 5-year age bands, which means that at age 30 it's one price, at age 35 the price goes up, 40 it goes up again, 45 it goes up again, and it can go up any time, even in between those bands, if the carrier decides to raise the rate, which is not guaranteed, or the company decides to change group carriers and put in a different carrier, the price can be different. So they also are not portable. So there's all kinds of reasons why group term life insurance is not usually a good deal. I mean, if you're buying it at age 25, it's about the same price as the open market, but your price is only guaranteed for that year, and by the time you're 45, you'll be paying more than you would be had you locked in a price on the open market, and it would be portable. So overall, not a great deal. If you're reasonably healthy, you owe it to yourself to actually go into the open market, see what it would cost, see how long the rate would be guaranteed, and I would tell you that 99 times out of 100, when you see that, you would select a privately held policy versus a group policy. It's almost counterintuitive. A lot of people think, well, my company's got 2,000 employees. I'm sure they got a group discount. They're getting a big volume discount. Like if you bought anything else in volume, you get a better deal. But because of the way life insurance is individually risk assessed, that actually hurts the carrier because they know that the worst risks are going to step forward. Now, getting back to our 21-year-old, there aren't many 21-year-olds on the planet that have a lot of people depending on them financially. So I don't know how many 21-year-olds out there are listening to this that are even thinking about adding or needing life insurance, but it's certainly not an urgent thing. I would only say that if there's a history in your family of certain medical conditions, like maybe diabetes, if your parents have diabetes or heart disease or cancer, and you want to lock in the coverage while you're healthy, then it might make some sense to get some coverage while you're young and healthy. That's one of the reasons why we sometimes look at life insurance on children. If the parents have a history of medical issues and they've wanted to buy life insurance and they've had a tough time doing so, it's either been expensive or unavailable for them, those are the people that are much more cognizant of the possible risks for their children and their children's ability to protect their families in the future. And it's why a lot of people will lock down life insurance for children while the children are still healthy.
All right, thank you. All right, so we did get a few questions about insuring children. So here was a question. I have considered buying life insurance for my children to lock in a rate while they are young and in good health. Is this a good idea? And what are the pros and cons of getting insurance for your kids when they are under 18?
That's a really good question, and I will tell you there is a lot of dissent in the financial guru space out there as to whether life insurance on children makes sense or doesn't make sense. I would say that one of the things that's absolutely true is if you buy life insurance while you're young and healthy, it's cheaper. You can lock in a rate for a long period of time at a low, healthy rate, when if you wait, you may not have the ability to buy it. Life insurance is a strange product, and unlike almost any other product on the planet, if you want to buy a crate of oranges, if you have the $10, you can buy the crate of oranges. With life insurance, it's more than just having the money. You actually have to prove you're healthy enough to qualify for it. And so locking down coverage when children are children, especially if it's permanent coverage, we actually have a video on that very subject, which may even be, I know it's available on YouTube. I think it's called Child's Whole Life, The Best Gift, or something like that. And we actually show an illustration of what this looks like if you buy it when they're young and how much money they'll have. You can pay for it over 10 years and then they own it. It's literally you own that chunk of death benefit, and then it has cash surrender values, and they can use it they can borrow against it to buy a house when they're 35. They can use it for retirement. It's amazing. I mean, it develops hundreds of thousands of dollars of cash because there's so much time for it to compound. And the other thing that those child policies do many times is if you buy a rider, a guaranteed insurability rider, it allows you to add additional amounts of coverage at later dates, beginning at 18, 21, 25, 30. And you can add, in this particular, the one carrier I'm thinking about, you can add up to $250,000 of coverage every 3 years, up to an additional $2 million of coverage over that child's lifetime without having to answer a single health question. So anybody out there that's ever had a problem passing a health exam or their health history has gummed up the works in trying to buy life insurance, if your child's healthy now, you can lock up their right to buy life insurance in the future for very, very little money. It's almost like an option. If anybody understands how options work, you have the option to buy a stock at a certain price. You have the option to buy life insurance at whatever age you buy it. You're going to pay the age rate, but you're not going to be paying based upon whether you're healthy or not. You're going to get the good health rate, which is very cool. So we like those. I think the video actually does a better job of explaining it than I did today.
Yeah, so for the LifeStages audience, we'll post the link to the video after the event, because it sounds like that's really an interesting...
Yeah, and there's actually an illustration that we actually show, and you can see the actual numbers as to how it works for an infant.
Yeah, and it sounds like there's lots of positives to considering that. Okay. We got a question submitted that was asking, many of our middle-aged friends, now this is talking about older children, are finishing college and feel as though they don't need their life insurance policies any longer. What should they consider during that stage of life regarding life insurance coverage?
So I'm assuming there are people about my age. My youngest child just graduated college, and everybody's different. There are people that say, well, I've got my 401k and I've got savings and I've got the house paid for and the kids' educations are paid for, and the only reason I had life insurance was till the kids got out of school, which is what a lot of people think about. But usually when they take a good hard gut check, they're still working, many of them. And I'm asking them, why are you still working? Well, it's not just to keep busy. They actually enjoy having the extra money and the extra security moving forward. And I said, if something would happen to you, would your spouse be okay the rest of your life? You may feel that once your kids are out of college that you don't need to support them any longer, and that may be true. Other people say, you know what, I really want to leave something beyond just my paid off house and my 401k to my children. A lot of people want to leave a little bigger legacy. They want to leave some money behind for their children, maybe for a down payment on a house. Maybe they want to leave some money behind for their children to have some money to start a business if they want to do that. And so if you want to augment your legacy, then you have to think about, hey, well, I have to have a policy that's going to be there when I die. And maybe they want that, maybe they don't. There are plenty of people that do say, hey, when I'm 60, I won't need the life insurance anymore. They get to 60 and they want to drop it. But I will tell you that with 200,000 clients, we pretty much see the gamut of what people are saying. I would say very rarely do we get a call from someone that says, hey, my life insurance is, I want to cancel my life insurance, I want to reduce my life insurance. For every call we get like that, we get people calling saying, I want to figure out a way to keep this going until I die so that when I die, no matter what else I leave behind, there's a clean amount of money that I'm leaving behind for my children, maybe for my grandchildren, for their college educations or whatever. There is no cleaner way to leave money behind than a life insurance policy that's in force when someone dies.
Okay. We got a couple of questions you've alluded to in some of your other answers around health problems and the process there, or can they still get life insurance? So we had one question, can you get life insurance if you've had health problems? Mm-hmm. And there was another question along the same theme of, I had an application rejected a few years ago due to health problems. Can I try again?
Well, let me answer the second question first so I don't forget it. Of course, you can try as many times as you like. The fact that you were rejected for life insurance, you do have to disclose that to the next carrier. And will that affect your ability to get life insurance from the next carrier? No. What will affect you is whatever your medical problem that kept you from getting the life insurance. A lot of people oftentimes ask me about MIB, which is a Medical Information Bureau, which is a repository of information that is sort of a third-party, not-for-profit that all the life insurance companies contribute to by providing the information that was given to them as part of the application process, so that the next carrier, if you try to, let's say the first carrier finds out that you had Canarcus of the Arcus and they don't want to insure you. Now 3 years later, you want to go out to the marketplace and try again. If you tell carrier 2 that you've never had Canarcus of the Arcus, they're going to see that you told carrier 1 that you had it. And so, is that a problem? Did we lose the video or no? Okay. We're okay?
Yep.
So the real problem is not what's in MIB, but the real problem is whatever the medical problem was that caused the problem to begin with. The fact that you've been rejected, it all depends on why you were rejected. If you were rejected because you had a certain kind of cancer and it was still too fresh and too new, a lot of times there's a waiting period before which a carrier will insure you. There are types of policies that you can get even if you have been completely declined at every carrier. You can still typically buy an accidental death policy, which will not cover you for everything, but at least it'll cover if you die in a car crash or you can get something, and something is often better than nothing. But we've found that with the number of carriers that we have on our menu, if there's any way to get coverage, we'll find it. And so some carriers are more lenient than others with various different conditions. We know diabetes is a huge, big issue in our country. It's running in epidemic proportions. So I forgot what the number was. Something like 20% of the public is either diabetes or diabetic or pre-diabetic. Obesity, cholesterol, cancer, heart disease. These are real common things that will muck up the works a little bit. It doesn't necessarily prevent you from buying life insurance. Understand that if you had a quadruple bypass and an angioplasty and you're recovering from cancer, if you're able to get life insurance, it's not going to be at the same rate as someone who's never needed those or had those problems and still running marathons. Obviously, the healthier you are, the cheaper it is. The younger you are, the cheaper it is. But the fact that you have a medical problem doesn't mean you shouldn't buy life insurance because it's more expensive. I tell people many times that if you are paying more, let's say it costs twice as much because you've got a medical history or because you're morbidly obese or whatever, the price is really the same for everybody. You pay more, but you don't pay for as long, and that's kind of like a joke, but it's not funny. They don't anticipate that you'll have to pay for as many years if you're impaired in any way medically. So the deal is the same. The carrier doesn't make more money on people that are medically impaired. They charge more, but they typically have to pay out more often and sooner on those people. So the deal is really the same. They're doing their best to equalize the math problem, which is what life insurance is. It is a math problem, and I've talked many times about the way to win the game, because it is sort of a game. I mean, let's face it. You think the carrier is always going to make money on you. You're giving them your money, and for that moment, it feels like they're making money and you're getting nothing. But the fact is, everyone dies. And so you either die with your life insurance policy in force or you don't. If your policy's in force when you die, they lose money on you. If you do the math, you'll see, take a look at what life insurance costs. There's just no way they can make a profit on people who die. So you say, well, how does that work out for them? Since everyone dies, how do the life insurance companies make money? Well, the fact is, they make money on the people who get rid of their policies before they die. They lapse, they go non-paid for whatever reason. Those people, those contracts, they make a fortune on because they collected money and they never had to pay anybody anything. And so those people ultimately subsidize the ridiculously high rates of return for the people who are smart enough to own a policy, hold on to it, and actually die with it. And that's really the secret of how to win the game of life insurance. There's a whole video on that as well. And I say the secret is 6 words: die with your policy in force. The die part, everybody can handle that part. It's the with your policy in force part of it that a lot of people screw up. And ultimately, it's how life insurance companies make money.
We had a question from a former smoker who asked, are they eligible for reduced rates, or should they go back to the insurance company if they have quit smoking for a period of time?
The answer is yes and yes. Okay, there are a number of ways to deal with that. If we have a client that bought a smoker rate policy and they have quit smoking for a minimum of 1 year, no carrier will consider you a non-smoker unless you've been non-smoking for at least a year. And the question I'm always asked is, well, how do they know that? Well, they're going to ask you, and you have to tell the truth. If you don't, you run the risk of not getting paid. So there's no point in ever lying to an insurance company, because then you're giving them a reason not to pay. But if you have quit for at least a year, you can either go to the carrier you're with and ask for a reduced rate. If they will not give it to you or they give you a hard time, then there's a free market out there. We can reapply with another company, absolutely. And the rate reduction is significant, assuming that everything else is the same. I did have a guy years ago we sold a smoker policy to, and he called me 10 years later and he says, "Hi Byron, you remember me?" I'm like, "Of course I remember you. I sold the policy myself." And he said, "Well, I have good news and bad news." I said, "What's the good news?" He says, "The good news is I quit smoking and I'm calling to see if I can get my rate reduced on my life insurance." I said, "What's the bad news?" He says, "Well, a couple months ago I was diagnosed with lung cancer and I'm dying." I'm like, "Well, I think you're going to like the smoker rate better than the lung cancer rate, because the carrier does have the right to ask all the other questions to make sure you're still healthy in every other way. So if you were healthy as a smoker and you're now a non-smoker and you're still healthy, yes, absolutely, the rate reduction can be well over half, sometimes more, sometimes 3/4, depending on how soon after. And if you've been out of the woods for 3 to 5 years, then a whole bunch of additional products become available, not just non-smoker discounts, but preferred non-smoker discounts. Once you've been 3 to 5 years out of the woods, from a rate standpoint, it is as if you've never smoked, assuming there are no residual health problems.
Okay. One of the questions, too, which is much more general in nature, is the difference between term and whole. And so we'll have you answer that. And then, should certain life stages people be looking and using them for different purposes?
The difference between term and whole, we could spend 6 hours on that one. I'll try to do the best I can in a few minutes. Term insurance is like every other kind of insurance that we own. You pay a premium for a period of time. If an event happens during that time, specifically death, the insurance company pays. If you don't die during that 1 year period, then you're offered a renewal. Sometimes the rates with term insurance are guaranteed for as much as 30 years with the level premium. So they are much better than they were when I first got in the business. There was no such thing as even 20-year term when I got in the business, not even 15. Every policy just went up in price every year as the risk of death went up. Nowadays, we can lock the price in for as much as 30 years, so these term policies are outstanding. We also have policies in the term arena that will guarantee your money back if you don't die at the end of the 30 years, which are called ROP term. That's kind of an in-between hybrid category. Permanent life or whole life, which is also mistaken for, I call it permanent life insurance because in the permanent category, there's whole life, universal life, variable life, all kinds of different permanent products that do more than just collect a premium and then pay if you die. They develop living values and or in many cases, they have a lifetime guaranteed premium. So in order to win the game of life insurance, we talked about the fact that you have to have your policy in force on the day you die. Now, any policy can work to win the game of life insurance, assuming you die with the policy in force. The problem is for term insurance or temporary insurance or the stuff that's very inexpensive to actually work such that it turns out to be a good deal when it's all said and done, you got to do something that you might not want to do, and that is die before you're supposed to. If you look at the price of a 20-year term on a 40-year-old, for $500,000, it's $30 a month. $30 a month, that's $360 a year, that's over 20 years, that's roughly, how much is that, $17,000? I mean, the odds of you dying, or is it even that much? I don't even think it's that much. But the point is, the odds of you dying during the 20 years is so slim that the odds are it's going to work out for the insurance company, and then the policy's over, and no, you didn't win, the insurance company won. If you want to win, you have to have a policy that's affordable, that you can afford to keep until you die. If we look at that, I just bought one. I'm 58 now. I was 55 when I bought my last permanent policy. It was roughly $10,000 a year, which sounds like a lot of money for $1 million policy. Wow, $10,000 a year. I could have bought a term policy for probably $1,500, but it would have expired before I die. This $10,000 premium never expires. I can pay for it for as long as I live. And let's say I live, I guess my over-under, if you were betting on me in Vegas for when I'm going to die, it'd probably be about 30 years. Okay, 85, that's when my dad died, 85. 30 years of $10,000 is roughly $300,000, or it's exactly $300,000. And when I die, my family gets $1 million, which is a $700,000 gain, 100% tax-free. What if I live longer? Well, how long could I live to turn that into a bad deal? Am I going to live another 100 years at age 55? I doubt it. Maybe we'll find a cure for death by the time I'm old enough. But realistically, I don't see much likelihood of me living long enough to turn it into a bad deal. So how does the insurance company ever make money on guys like me? Well, I can tell you, they love me today because I've brought them 200,000 customers, but the industry's going to hate me when I die because I am going to die with my policies in force, and they're going to say, why the heck did we sell this guy so much life insurance? Because we lost money on him. And so the real difference as I see it, if you're looking at life insurance as a protection product, as a death benefit product, is that permanent life insurance, whether it's whole life, universal life, or any other kind of permanent life insurance, if it's designed to remain in force until you die, and it is kept in force until you die, it is a winning financial instrument. It's a winning proposition. You and your family will end up collecting way more out of the life insurance industry than you ever could have possibly put in. Term insurance, if you die young, it's an even better proposition because it's so cheap and you're going to collect so much money for so little. $30 a month for a $500,000 policy. I mean, how does that work out for the insurance company? Only because so few young people end up dying, and the ones that do, they pay promptly. There's no difference. I mean, all the carriers that we do business with, in fact, most of the carriers that even issue life insurance are A or A plus rated. There's no issue. It's not like car insurance where you buy a crappy one and they resist claims. They all pay their claims. And so, the big difference, as I said, if I had to point it out between permanent life insurance and term life insurance, is that permanent life insurance is designed and it is affordable and it has a level, predictable premium for life, and you can keep it until you die so that you can actually have a chance of winning the game of life insurance.
You mentioned in that in your explanation there, ROP, or return on premium, which is interesting. I think if people just think that there's term or whole, they don't understand this whole other flavor of unique products like the No-Med or this ROP. So can you explain a little bit more about exactly what that is?
Yeah, ROP term really hit the market right around 2000, 2001. We were actually instrumental in helping it come to market. We worked with one carrier and we said, look, if we could come up with a way to give people their money back at the end of 30 years, we might remove some of the objections to buying term life insurance, because term life insurance, the big objection is, I don't think I'm going to die young, so this is going to be a waste of money. So with the way ROP works, it's more term-like pricing. Okay, so it's nowhere near the price of universal life or whole life. It's term-like pricing, which means it's cheap, translation, cheap. And then at the end of 30 years, if you haven't died, you just get a refund of 100% of the premiums you paid, 100% income tax free. So hypothetically, let's say you paid $1,000 a year. Let's say you would have bought a 30-year term policy for $500 a year, and now you buy an ROP term policy for $1,000 a year, which is way less than the $3,000 or $4,000 it would cost for permanent insurance. You pay $1,000 a year. At the end of 30 years, to me, it's like putting money in a piggy bank every month. You put money in a piggy bank, $1,000 a year, that's roughly $80 a month. $80 a month, you put it in there. If you die, we give you the death benefit, which could be $500,000 or $1 million or whatever it is. We'll just take whatever's in the piggy bank. And if you don't die, whatever's in the piggy bank at the end of 30 years is just your money. You just take it and crack it open and have a party. Now, what will $30,000, if that's what you're paying for the ROP, what will $30,000 buy at the end of 30 years? With inflation and everything else, I don't know. Will it buy a new Camry? I don't know. Probably not. Will it buy a large pizza? Probably. At the end of the day, it's better than a sharp stick in the eye. It is 100% refund. And there are those that will be skeptical or cynical and say, well, what about the interest on that money? That's how the insurance company is making money. And that's right. They are going to invest the money. But how are you investing your money? Are you making a huge amount of interest on your money? Because as we talked about before, interest is hard to come by these days. And it's been low for a prolonged period of time. I can't remember. It was sometime in the 90s when banks were still paying interest on bank accounts. And so if you're not earning anything on your money anyway, what's so bad about putting money in a piggy bank? We teach our children to put money in a piggy bank. Why do we do that? Well, because it's fun and it's a good idea to actually save money. If I told you that you had to put $5 a day in a piggy bank every day for the rest of your life, and you're not going to get any interest on it, but in 30 years you can open it up, I don't think you'd be stomping your feet and pounding your hand on the desk saying, boy, that's a really stupid idea. I don't want to do that. It'd probably be a good idea. I'd probably have a little more money if I forced myself to put $5 a day in a piggy bank. Not such a horrible thing, but at the meantime, by doing that, you create hundreds of thousands or even millions of dollars of life insurance that's there, and they'll just take whatever's in the piggy bank. If you die in 2 months, all they get is $160, and you get $500,000 or $1 million, depending on what that ROP term premium is, and it varies depending on your age. Typically, ROP plans are available all the way through age 50, which is actually really nice. So
that leads into another question we got about using life insurance for estate planning or as an investment tool. What can you speak to about that, and what are some thoughts around it?
Well, a lot of wealthy people. I'll make this statement sort of generally. Maybe it's a generalization, but generally, wealthy people are pretty good at math, right? Agree? I mean, they didn't get wealthy by being stupid with math. And so what they've found out, or they've determined, that the life insurance transaction makes sense for them as a family. Now, in other words, the amount of money they're going to put in versus the amount of money they're going to get out. They can create dollars to be delivered at a future date, exactly when they're needed most. They look at it as a diversification mechanism. They also, in other words, if I die young, life insurance was the best investment I could have made for my family, because it blossoms into millions when every other investment is just worth whatever it was yesterday, incrementally today. It doesn't really change much at death. So life insurance is a way to diversify, and it's hard for me to fathom anybody thinking that their portfolio is diversified without having some life insurance in it. Every financial advisor on the planet recommends diversification. We all know that. They may not agree on what to invest in, but they're not going to if you had $10 million and you walk into a Merrill Lynch guy, he's not going to say, we're putting it all in Disney. You'd be like, get out of here, I'll find another guy. So everybody agrees to diversify. For estate planning, life insurance is a way to take pennies, turn it into dollars, and have that money delivered exactly when it's needed most to offset potential estate taxes. Estate taxes are not an issue for most people these days. A couple would need to be worth roughly $11 million or more before they'd even be an issue if your estate is set up properly. Used to be anything over $600,000, and the government started taking half of everything thereafter. It's not like that anymore. So the uber wealthy clearly still use life insurance as an estate planning tool as a way to discount the taxes. And the way I talk about that is, if the IRS is at your head with a gun and say, well, you have to flush $100 down the toilet, and I'm next to you on the other side of you saying, I'll sell you the $100 bill for $10. Whose money are you going to flush down the toilet, mine or yours? I mean, why not buy mine? It's cheaper. It makes perfect sense. So yes, wealthy people still use it for estate planning, and then non-wealthy people use it for estate planning to create an estate, not to preserve an estate, but to literally create a legacy to say, look, I don't have much of an estate. I have a house that's worth X number of dollars. I owe just as much on it as it's worth. I have a little bit of a bank account, but when I die, I don't want to leave nothing behind, especially if I die young. So you can use life insurance to create an estate, so that even if you didn't have time to build it to leave behind for your kids or your spouse, that you have created an estate where one really didn't exist before. And so, yes, it's an amazing estate planning tool. What was the other part of that question? I forgot.
It was estate planning and as an investment tool.
As an investment tool. So life insurance as an investment tool during life, it can work, okay? There are a lot of caveats, though, and there are a lot of situations where it does not work. And so most of the financial gurus out there that are on television talking about what you should do generally don't recommend life insurance as an investment tool per se. Now, that being said, I just got my statement from a whole life policy that I bought 26 years ago. I pay $4,600 a year. Happy to show you the statement. In fact, my statement is actually on one of the videos which we can also make available to you. I pay $4,600 a year. It has a waiver of premium feature built in, which means that if I were to become disabled, they'll pay the premium for me, the whole $4,600, and the cash value today is roughly $231,000, which is almost double what I've paid for it. My death benefit started out at $500,000. It's now $650,000. Was that a bad investment over the past 25 years? I got to tell you, it's impossible to find anyone on this planet that bought a good permanent life insurance policy from a major company that's owned it for 20 years or longer, that's not happy about it, doesn't look back and say, my God, I wish I bought more of this. It's an amazing product, but you have to have staying power. If you look at it after 3 years, I paid 3 payments of $4,600. It was worth about $1,000. If you looked at it then, you'd say, this is crazy. Why would I do this purely as an investment? It takes a long time for it to catch up and actually start turboing out to make it look good. But once you're over the hump, once you're past 5 or 10 years, you take a look at what you're putting in, you take a look at how much it's growing, especially whole life, because it's a really, really cash-rich plan. The downside of whole life is it costs so much money for the death benefit you need. If you needed, let's say at age 35, you wanted a whole life policy, instead of being 50 cents or $1 a thousand like term insurance, it's $10 a thousand. So $1 million policy would cost $10,000 a year. Who has $10,000 a year to spend on $1 million policy if that's what you need? So it's very difficult to buy the amount of face amount you need at a young age when you're worried about getting a nicer car, buying a bigger house, maybe a bigger condo, putting money away for the kids' education. Who's thinking about who has extra money to put into whole life? But yet it's sold every day. I had the foresight at 30 or 32 years old or whatever age I bought it to buy it because I was selling it and I saw it. I was playing with the illustration software and I saw that if I can just stick this thing out, this will work out really well for me, and I'm really glad I did stick it out. Because I just got my statement the other day. I get it at the end of beginning of July every year, at the end of June, and I put it on my desk and it reminds me of how good this stuff is. But again, to use it purely as an investment without the death benefit component of it, I think there are better investments on the planet. Yeah.
We're nearing the end of our event, but I want to get 2 questions in quickly. You've talked a lot today about all the breadth of types of products and price ranges. It seems like there's something that should be appropriate for everyone. We got a question about, is there, similar to bundling other services, is there options when you buy life insurance to bundle it with your home or your car for discounts?
There may be some options at carriers that sell homeowners and auto insurance, but I have not seen discounts on life insurance. I've seen discounts on homeowners insurance if you buy the car insurance, and I've seen discounts on the car if you buy the homeowners, but we don't sell property and casualty insurance at all. What we do is we have a multi-carrier platform on life insurance, so we search the entire market looking for the best deals, and whatever deal, we have roughly, last I checked, certainly in excess of a dozen State Farm agents as clients of ours. So they've chosen to buy their life insurance from us, which I find, they don't want State Farm to find out about it, but that's true of some other property casualty companies as well. So they've obviously crunched the numbers and determined that it's better for them to go into the open marketplace. I remember the very first one I had, it was just such a flattering thing to think that a State Farm agent who only sells State Farm felt the need to come to me to buy their life insurance. So not a big deal, really. I would not say bundling is a big factor in the pricing of life insurance as it is with different types of homeowners and car insurance.
Okay, and so our last question is for the pet lovers out there. We had a question submitted of asking, could you assign your pet as your beneficiary to your life insurance policy?
That's the first time I've ever gotten that question. I would say probably not, but what you could do, if you wanted to do that, is you could open up a trust or set up a trust that is designed to take care of your pet, and you can always make a trust the beneficiary of your life insurance policy. So the answer is no, but yes, if you really wanted to, all you need to do is set up a simple trust, and you obviously have to have a trustee that's prepared to administer those funds after you die to make sure your pet is taken care of. But to name your pet directly, like you're going to name your goldfish as your beneficiary, I'm not sure the insurance company would know what to make of that. And you certainly wouldn't want to tell them that's what you want to do when you buy the policy, because they might deem you to be mentally a little out of it, and they'd be questioning your sanity as to whether that made any sense. But people love their pets, and if they want to set up trusts to make sure their pets are well fed and taken care of, or whatever, there's certainly ways to do that. Absolutely.
All right, great. Thank you so much, Byron. This has been a lot of great, useful information, hopefully a lot of new information to people thinking about life insurance, which is so important. So we thank you all for joining our Q&A. We'll be answering some additional questions online post our event. And if you would like additional information or would like to speak to an AccuQuote insurance expert, you can go to AccuQuote.com or 877-654-8913. Again, 877-654-8913 to speak to an AccuQuote agent. So again, thank you so much.
Pleasure doing this.
And appreciate everyone's involvement, and we'll have more follow-up and be providing more of these in the future with our whole goal of providing you with useful resources at LifeStages. Thank you.